In February 2026, the tech world faced its Lehman Brothers moment. We saw the SaaS apocalypse, a 48-hour window where hundreds of billions in software value vanished. As the market realized that the old per-seat model was being automated out of the system, but to truly understand why this happened, you have to look past the stock tickers and into the cold math of the ledger. I'm sitting down with David Snyder, CIO of Journey One Advisors. David, welcome. Let's get straight to it. You lived through 1999 and 2008. Looking at the circular flow of capital today, where big tech is essentially funding its own AI revenue, is the SaaS apocalypse we just saw in February the final warning sign, or is it just the first domino in a much larger systematic collapse?
Well, I really think the market is way overdone how much old tech is going to be affected by AI. It's just the similarities are so strong with the late 1990s with the internet. Back then we had almost every industry was going to be disrupted and made obsolete by the internet, whether it was real estate, distribution, all the financial firms are going to lose out to internet trading. And so they really depressed the valuations dramatically. Like in drug distributors, there was no need for a distributor. And you had this incredible increase in valuations of the internet, while at the same time, lowering evaluations in all the industries that people perceived was going to be affected negatively. So today you have the same exact thing obviously, software as a service is the number one industry that's being affected, and the valuations have declined by 60 to 70% over the last year. However, my belief is that it's way overdone, just as the internet was overdone. Back in the late 1990s, a lot of those industries that people thought were going to be disrupted actually ended up surviving and doing very well. And the returns from March of 2000 for the next 10 to 15 years actually were very strong for a lot of those groups. For instance, the real estate investment trust, they were one of the best performing groups from March of 2000 and 2015. So today you have the same thing. So there's just too much enthusiasm for AI and how much it's going to disrupt, and how they don't believe these industries are going to be able to adjust to the new to AI and adapt it in their models. So we're seeing a very similar dynamics playing out. It's somewhat eerie that it's so similar to what happened in the late 90s, which would mean eventually that AI bubble will burst, and then all of the industries like software will actually increase in value as they go down, when people realize that they will benefit from AI.
Whoa. Yeah. So back to the 90s to 2026, and the big thing, I think, you said a lot of interesting things in here, but the big thing was the last thing that you see, the AI bubble bursting. That's very interesting. I mean, you're definitely on the other side of the fence with that one compared to most people, I think. You care to go a little bit deeper into why you see this particular bubble busting? I know most people say that history may rhyme, but it's not the same.
Well, it's every generation has a new revolutionary technology. Every secular bull market had a new revolutionary technology. We had the railroads in the 1800s, and then in 1893, Pennsylvania Railroad, Reading Railroad went bankrupt. They overexpanded. You had in the 1920s, car ownership went from 20 to 60%. The automobile changed the world, and however, they overexpanded, and we had the Depression. And of course, in the late 1960s, we had the first technology rally, and it was because of Moore's Law, and where integrated circuits were first mass produced. And it was an amazing new revolution, miniaturization of computers. And that all came to a bust in 1969. And then, of course, you had the internet in the late 90s, which is a new revolutionary technology. So this is nothing new. This has been repeated time over time. Marcus, it doesn't matter how good the technology is. It's the human response to a new technology. So there's three factors. The first factor is the companies that are developing the technology and using it become overenthusiastic. And so they invest more capital than they should in the short term. Their second mistake is it's called FOMO, fear of missing out. So they'll invest more than they should because they don't want to be left behind. And those are two on the corporate side that cause overexpansion. So we've had every one of the major hyperscalers say they are going to err on the side of overspending. So they're basically telling you they're going to overspend. So you have that, and then you have on the investor side, the investors have an insatiable demand for this new technology, and then they overvalue all of these companies. And so again, it doesn't matter what the technology is. It's those three factors I just mentioned, the human response to those technologies. In fact, I would argue the better the technology is, the more likely the bubble is going to burst. And what we know also is that these things, the bubbles burst in the first 5 or 6 years of a new technology. And so everybody is saying that AI is just in the first or second inning, just like they said the internet was in the first or second inning in 99, 2000. But they're right. It is the first or second inning, but a bubble burst. And then the internet grew when the internet the bubble burst in 2000, internet still grew dramatically for the next 20 years. So it's just this interim period where people become overenthusiastic and overinvest. Investors also, overvalue, and then the whole thing burst when just one little thing goes wrong to end that kind of perfect scenario.
Okay. So those are definitely interesting takes, contrarian takes for the most part, like I said. I think some people would say maybe on the other side of that. So, and even as I'm posing this question, I'm kind of thinking this myself because, so we have these companies now. There are some of these are the greatest companies in the history of the world, correct? Like modern technology, you can kind of say that maybe. But I guess with all these other revolutions were happening, those companies were also like the greatest companies in the world at the time. My question is and I'm sorry to dig so deep into the AI bubble, but that's a big thing. My question is, how do you see the companies leading the way now? So you have the Metas and Google, companies like that spending a lot of money on this CapEx compared to who was leading back then, Cisco, IBM, which ironically this old tech has come back into play. How do you see the leaders now compared to the 99, 2000 bubbles leaders?
Well, I think they're very similar. They're both all of the hyperscalers that are leading this basically have negative cash flow. They're spending every dollar of their operating earnings on CapEx. And so there is a big discrepancy now between earnings and cash flow. And we haven't had that discrepancy since the late 1990s, when there was also this huge increase in capital investment for the internet to, broadband and, all of that. So it's very similar. The market, and by the way, these cash flows are not going to increase much for the next couple of years. So you have to, if you really believe in these AI hyperscaler names, you have to believe in 3, 4, 5 years they're going to get a return on their capital, because they're not going to get it in the next couple of years. I mean, they even, the projections. In other words, they're still in the CapEx investment cycle for this. So it's very similar in the sense that they are spending enormous amounts of CapEx for this new technology. And if we continues, they're going to end up, the similarities are they're going to end up that they're going to realize they spent too much money on all of this. And then, of course, their earnings and cash flow will go down even more because they won't get a return on investment that you're hoping for, at least not in the near term. But then what's very interesting, what happened in the internet is broadband prices dropped like 95% during the bubble burst. And that actually, ironically, increased the demand for broadband because the prices came down. So you could have the same scenario this time where all this money spent on data centers, on AI, all drop dramatically in value, and that actually will stimulate the second kind of expansion and even better expansion because you're going to be doing it at very low prices. So, we have that. We have the competition with China. China is way more efficient on a dollar, per unit basis for AI, literally 10 times more efficient in spending money on the internet. On AI. They're getting similar results for spending 30, 40, $50 billion, and we're spending like 700 billion. And they're getting similar results. So it's what could happen is all the capital could chase the capital invested could move towards more efficient models. And so that's another possibility how it could burst. It could burst because the data centers, it's very hard to get approval. It's, not in your backyard, not in your backyard development. And there's all kinds of issues over water, over chemicals, over increased utility bills. The state of Maine just outlawed any new data centers, although the governor is going to overturn it. So, if you don't have enough data centers, it doesn't matter if you have a lot of demand, you're not going to be able to fulfill it. So there's all kinds of things that are possibly going to go wrong. There is just an IPO of a nuclear module nuclear power company that won't have anything up and running till like 2032. Valuation was just enormous earlier in the week. So the market is investing in something 6 years from now when they will just finally have an operating system, which is just crazy. And who knows if, the politics change, Democrats are not in favor of nuclear power. If Trump loses in 28, Democrats could come in and put all kinds of regulations back on nuclear, and they may never ever, come close to meeting so we have all of these crazy scenarios happening, just like it happened in 99, 2000. So, and the other thing, Marcus, is one of the most, every cycle this happens. So in 2007, before the financial crisis, Blackstone, the biggest leveraged financial, private equity company, went public 2 or 3 months before the financial crisis, sucked everybody in, and then the whole thing fell apart. You had Coinbase went public in April, May 2021, right at the top of the Bitcoin, the crypto bubble. You had in 99, you had 2000, you had Priceline, and the biggest IPOs came in 99, right before the internet bubble. So what I'm waiting for is we now have SpaceX, Anthropic, and ChatGPT, all $1 trillion or more valuations are going to go public in the third and fourth quarter. And so I don't think the AI bubble is going to burst until they go public, because that will suck in all of the money into those 3 companies, and then the market will go down afterwards, just as every other cycle. That's the way it happens. So that will be the top when all those go public within a few months after, most likely. That's worked in, historically, that's the way it's worked. When you go bring the biggest players public right at the end of a favored industry.
Wow. Yeah, those are some eye-opening facts right there. Some ways to go back and just analog with the past, and it definitely is similar as far as it goes. I would say so with the hyperscalers, and I argue, and I'll tell people this, like Apple's one of the best companies ever, right? Apple doesn't spend a lot of money. They haven't spent a lot of money in this AI build out. And Apple's going to be, in my opinion, and don't take this as investment advice, anyone listening, for like a specific stock, but I think Apple looks like they're going to be the one that will come out on top, just based on their already user base that they have. They haven't spent a lot of money on CapEx inside of AI. So, and another thing is, I do think that with the AI, some of these big companies, like some of these huge companies that we hear right now, they're going to go away. Like they'll never be here again. And people are going to be amazed by this fact.
Well, you're right, because Google didn't go public until after the internet bubble burst. So some of those dominant companies occurred after the bubble burst. So we don't know who that's going to be. As for Apple, is just licensing the technology. That's great, but in the short term, but in the long term, you never make as much money licensing something as you do actually making it. So that's the negative, and they won't control their destiny with it because they're always going to be licensing from somebody else. So I think in the short term it's good for Apple, but in the long term they're going, they're not making these investments. It's going to, and then of course with Apple we have that we need, with the glasses, we may not have, the phone might not be the center of our universe in 10, 15 years. So they have that risk. But as far as the AI, it is, in the near term, they will do better on a relative basis. So I agree with you there.
Yeah,
But
and Apple also has all those services built in. I know my Apple Music payment comes out every month. You have also, but so thinking about in the same vein, like, so think about Apple and their multiple sources of income, which may be a reason why AI wouldn't sink this company. Google, Alphabet, right? They have a lot of things, different ways to incorporate money. They have YouTube, they have Waymo, which they haven't even put on the books yet, which I guess will have to play into the AI if that's going to be some type of driverless technology. Like, and then even Meta with the Facebook, but they're spending a lot of money as far as hyperscaling go. Does the way that these companies are funding this, like, so like Apple, it's a small percentage and they have a lot of other ways of making money. Google is a larger percentage. They still have a lot of ways of making money. But then you go to someone like Oracle, who Oracle has, not a whole lot of ways of making money. They were based on the SaaS model somewhat, even though they're into the data centers and they're into the software. So it's a layered question. Dig into it.
well, so first the SaaS model, it's going to change to a value added model. So there may be just some disruption in the near term, but these companies are going to learn to just sell their services as on a value added basis instead of on a seat basis.
Can you
So
expand on what
that's,
that means?
well, basically these software service, when they sell seats, they add each unit, each person, a new employee is going to get a new seat, is going to be using all the products. So they're basically tied to how many people they add to their user base. And so with that being disrupted, they're now going to just do it, change to a model where they'll just charge companies how much they use on a value added basis. So what should happen is they should see more revenue per person using it, even if they're not, you're not using, getting additional seats. So the whole model will change. Getting back to all those companies, all those other companies have divisions that will, they're not going to get in financial trouble because they do have the security of these other divisions to provide cash flow. The only thing I would tell you though is that the companies just mentioned are heavily dependent on advertising revenue, and especially Meta and Google with YouTube. And that is a highly cyclical industry. If you look in 2022, we didn't even have a recession, and all of those companies had big earnings declines. So, if we go into a recession, there will be they won't have as much support because they're going to lose, just like in 22, it'll be even worse. They'll have much lower earnings because the advertising revenues will shrink in those other divisions. So then they'll even have less support for CapEx. So that could be an issue for them down the road.
Gotcha. Yeah. And so I'm glad you elaborated on, because I think from the conversation that we had so far, people may have gleaned that you were mentioning that like these companies will go belly up, all of them, just if the AI bubble bursts, which we are going to get into if this AI bubble bursts. Let's talk a second before we get into like what it will look like if this bubble bursts. How about you give people some signs that they should be looking for to see if this bubble is about to burst? What are you seeing that makes you just said a few months, a couple minutes ago. So what's giving you that time
Well,
frame for a burst?
I think it's going to happen within the next 12 to 18 months. So one of the biggest signals is these major companies going public. Anthropic, ChatGPT, SpaceX, although it's not directly AI. That's a big warning sign. You have, what could happen is, as I said, there's a lot of things that could go wrong. You're definitely going to get a deceleration. I mean, they've been growing CapEx by 50, 100% the last couple of years. It's definitely, even in the projections for 27 and 28, they're definitely going to slow down, although they'll probably raise those numbers. So there will be a slowdown. but there may be a point, you're going to look for, some kind of news where they're not getting, I don't think this is it, but the reports yesterday in the media about ChatGPT not meeting their goals on revenue. So if you get more of that kind of, commentary, that could be the tip of the iceberg to start. And it's all a vicious cycle. Once it's going to hit all the way back to suppliers, to the data centers, to the industrial companies that provide the electrification for the data centers. So everybody's tied into this cycle on AI. So they're all going to, if one gets hit at the top, everybody else is going to get hit, or all the way through the supply chain. So it can just be a vicious cycle on the way down. So there could be all kinds of things. There could be, the chips aren't, become so efficient, you don't need as much data center power, or just, all kinds of things like that could happen. But the biggest thing will be, in my opinion, they won't get the return on investment, and then they'll have to slow down their CapEx. I think that's going to be the biggest issue. Institutions are slow to change. As good as this new AI technology is, it's hard. You're talking about having, these systems ingrained in these corporations. To tear them out, it doesn't happen as quickly as people would hope for when something like this happens. People are slow to adopt these new technologies. So I think that's going to be an issue nobody's really thought about, that it will take more time. Even if the technology is that good, it'll take time to adopt. So it's just going to be a slower, pace. I mean, I heard yesterday somebody on CNBC say that they hope that it does slow down, because that way it won't be, get out of hand. And I'm thinking, no. If there's any evidence of a slowdown, all of the stocks are going to get hit really hard. It may be good for the long run, but it would be a massive sell-off if they all started to slow down their spending in the short term. So we're at a point of no return. I mean, if they start slowing down now, it's going to be a disaster. If they keep spending even more, it could you're causing even more of a bubble. So they're in a catch-22 at this point, the hyperscalers. So I think it's a very dangerous. So there are so many. You usually need a catalyst to get the market to go down, especially these hyperscalers and all the AI. So you need some kind of we have these oil prices staying really high. These are real companies, Marcus. So people think, oh, they're just going to adopt AI no matter what. Well, let me tell you, if oil prices stay high and we enter recession or just whatever slowdown, these companies have to cut spending. And people think they're not going to cut AI spending. No, they will cut AI spending, or they won't grow as AI spending as much as they were hoping to. So the overall economy can affect the AI spending. So but oil prices today, just what did I see, rose $5 to like 104? I mean, it's 7 weeks into this. So that could be the catalyst down the road if that continues. So we have every measure we're extremely overvalued in the stock market. So when you get to this level, it doesn't take much. You're very vulnerable to any kind of bad news because you're at such high valuations. And by the way, Mark, it's not just valuations. Everybody's saying the tech valuations are lower today than they were in the late 90s, which is true. It's really earnings. So earnings caused the collapse of the internet bubble more than the valuation. So you could easily get a 50% drop in tech earnings in a bubble burst. So right away, if you have a 50% burst 50% drop in tech earnings, and you remember the big bulk of tech earnings now with semiconductors doing so well. So you could see, if you have a 50% drop in earnings, you could easily see a 50% drop in the stock market, right? Because if you just stay at the same valuation level. So I'm not convinced just because the tech, and then you have the other industries like industrials, which support the AI. The industrials are trading at all-time high valuations. So it's not just tech that's causing the PE to be at 21. So you have a lot of other industries that are somehow attached to the AI revolution that would also come down dramatically. Marcus, this is so similar to the late 90s. It's almost too easy. We've had, I mean, too easy that it'll top, that the bubble will burst in the next 12 to 18 months. I mean, we've had 17 years of real returns in the S&P 500 of about 15%. That's exactly almost to the day. It's very within months of the 1949 to 66 bull market and the 1982 to 2000. Both of those are about 17 years and about 15 to 16% real returns. Real returns are 6.5% a year over the last 100 years. You don't have to be a math genius to know. If you get 17 years of 15% real returns and you average 6.5, the next 10 to 15 have to be like negative real returns, which is what happened between 2000 and 2009 when we had negative 3 or 4% a year returns or 3% a year returns. So we are, we're following almost to a script what happened that ended the 62, the 49 to 66 and the 82 to 2000 bull markets, almost to and the other eerie thing is the biggest, at the end, it was the semiconductors. And if you notice, the semiconductors have been on fire for the last 3 weeks. Well, I went back and in the internet from June of 96 until March of 2000, the semiconductor stocks, the index went up 8-fold. From October, using that's 3.5 years, right? From using October of 2022 until today, which is about 3.5 years, we're up about 6.5-fold in the semiconductor industry, which is these are like the 2 biggest increases in semiconductors ever. But the parallel, 3.5 years, almost the exact same parabolic increases as back in the late 90s. And by the way, we had the same thing in the late 60s with semiconductors, had this enormous run, and then the bubble burst. So we have that parallel, which is just scary. And both of those bull markets, Marcus, in the last 5 years is when a new revolutionary technology came out. And back then it was the integrated circuits, the Moore's law, and also the aerospace. So you had, now this is the same way. We had the last 5 years has been the AI, just like the last 5 years in the 90s was the internet, and the last 5 years in the 60s was integrated circuits. It's crazy how closely they parallel. And, also we have right now, price to cash flow is 28 times the S&P 500. That's the highest since the late 90s. We are the biggest discrepancy between price to cash flow and price to earnings since 99, 2000. Another incredible parallel. So we have just incredible, and then of course we have the parallels of the disruptions of every other industry going down, like software. And back then it was, real estate and what we discussed before, all the, so we have that parallel. I mean, there are so many parallels. It's crazy. It's just incredible to me.
Yeah. All right. Hold on, David. Let's pull up and take a breath for a second. There.
Okay.
You just gave Main Street a lot. People might be calling and trying to get out of all of their AI investments right now listening to this.
Right now. I'm not saying right now. I'm saying within the next 18 months.
No, you're good. I understand what you're saying.
And by the way, Marcus, don't forget, the biggest gains occur at the very end and the biggest losses occur at the very beginning of a bear market. So it's very difficult to time. It's
impossible to time almost,
Yeah.
I was going to say, just speaking back to the market, this market may be different though. I don't know. You've seen a lot of markets, maybe all markets are the same. So you talk about resilience And you mentioned China and how much cheaper they are using AI technology. We saw DeepSeek at the end of 24, if I remember correctly. And that was really like a Lehman Brothers moment for NVIDIA, if everyone remembers. It went really far down, but then it came back. And then we've seen, let's say, I'm just trying to think since DeepSeek, we had tariffs, which were, we saw what we did to the market. The market just moves different. And now we're in this Iran conflict. The market moves different. I don't know if it's the speed of information. I don't know if it's the retail investor. A lot of people invest in the market have never seen a recession, like they've never seen the market go down. So people are sitting here listening to you speak right now, David. Go back and tell them a little bit about yourself and your history and what you've seen so they know, like, pay a little bit of attention to this ghost whisperer we have on here right here.
Well, you're right. It seems different, but actually what's happened so far, Marcus, is exactly what you would have thought would happen. In other words, if I go back to March of 2009, when this secular bull market started, and if you had told me back then, Marcus, if you had told me, Dave, it's a new secular bull market, what's going to happen? And here's what I would have told you. I would have said we're going to have 17 years of about 15 to 16% real returns of a secular bull market. It's going to last 17 years. And at the last 5 or 6 years, I don't know what the technology is. We're going to get a revolutionary technology that's going to capture the imagination of investors. And it's going to cause a bubble. And the bubble is going to burst. And the secular bull market's going to end. So that's exactly what's happened so far. So nothing that has happened so far wasn't predictable based on the past 2 secular bull markets before this. I mean, we're perfect. It's almost a perfect now. But what I will tell you is, if this lasts past next spring, then it will be different. Okay, then it will be different. But in those two, but Marcus,
say that again for the listeners, David. What you just said.
If this secular bull market AI lasts past next spring, it will be different than any other secular bull market, because that would last more than 17 years. And the returns would still be, very high. But you're talking, you're talking about how the market bounced back from tariffs, from the oil spike, from the Iranian war. But in the late 90s, Marcus, we had the Asian crisis in 1998, and that was very severe. We had a depression in a lot of countries in Asia, and we had the long-term capital where they almost went under. So people were shocked how we bounced off of that and came right back. 98. Like, that was a 20% drawdown in a couple of months, just like the tariff did. But we bounced back immediately. And we had in 96, we had a high yield crisis, and we had, different things happen, and the market would keep coming back. And people would say to me, Dave, this market's incredible. It just comes back. It doesn't matter. People just buy the dips all the time. Yeah, well, that happened for 17 years. And then after 17 years, guess what happened? The internet bubble burst and everything went on. So when people tell me, Dave, this market's different, it's resilient, we have everything that happens to it, whether it was the inflation spike in 22 or the, tariff, tantrum in 25, or the oil spike to this in 26, the market just comes back. That's what happened. It's no different than what happened in the late 90s or the late 60s. Only if it continues past next spring will I be convinced that this is something different. And I don't believe it will. This one thing we haven't talked about, Marcus, is productivity. Everybody thinks it's going to be the panacea, right? And it really hasn't happened yet. People keep quoting these huge productivity gains, right? However, we had negative productivity for like 4 or 5 quarters in 22 to early 23. So we have had increased productivity since then, but that's only because we have had a big, rebound from negative productivity growth in 22, early 23. So if you average that out, it's really not that great. Okay. And if you go back, I think I saw that after 20, productivity is only averaged a little over 1% a year growth after 21 and 22 until now. But everybody will quote you from mid 23 until now, and they'll say productivity growth is 2% or greater now. But that's just a function of a rebound from a decline. But here's the problem with productivity. In 2000, we had the highest productivity we ever had, 4.2%, I think it was. And the stock market went down, 15% that year. The economy went into recession the following year. My point is, it's not a panacea. When it depends on the context. Productivity grew 3.2% between 2000 and 2004. That was higher than the 3% from 1995 to 99. Yet the stock market went down in real terms 4% a year from 2000 to 2004. So productivity growth was the highest ever, not the highest ever, but the highest in multi-decades from 2000 to 2004. And we had not so great economy, and we had stock market declines on average, annualized at about minus 5% on a real basis. So it's not a panacea. Even if we have a pickup and by the way, inflation went up in 2000 from 2.8 to 3.4%, even with productivity of 4.3%. So it depends where you are in the business cycle. If you're already close to full employment and inflation is starting to rise like it is now, the productivity is not going to save you. It didn't save us in 2000. So I don't think it's, we have no labor force growth because of the demographics, as you know, because no immigration and because of the baby boomers retiring. We have a decline in the labor force, out there. So that means you are dependent on productivity for growth. I don't know if you know, from 1950 to 2000, productivity grew. The GDP grew about 3.5%. And of that 3.5%, about 40% was from aggregate hours worked. About 1.6% a year, aggregate hours grew. So you had almost 40% of GDP growth was aggregate hours. We can't grow aggregate hours now much, okay? Because of the demographics. Aggregate hours are based on, how many hours the labor force increases every year. If you don't have increase in the number of people working, you're not going to grow aggregate hours. And with the demographics, it's going to be very difficult. So my point is, almost half of GDP growth came from aggregate hours worked. Now, in the next 10 years, we're going to almost have no aggregate hours. So we're totally dependent on productivity. And so if productivity does it needs to grow, over 2% in order to get GDP at 2%, because you're not getting you're losing that whole other growth factor. So that's something that people don't understand. And so, yeah, you will, even if productivity goes up a lot, it's not going to offset the loss of aggregate hours growth that was 40% of GDP growth from 1950 to 2000. So
Okay.
that's a big, big deal that people aren't thinking about, overall. And also within that, Marcus, so even though aggregate hours grew 1.6% from 1950 to 2000, the number of hours people worked declined. But because labor force growth was so high, it was greater than 2%, aggregate hours can go 1.6%. So if we continue this trend of people working fewer hours in the workforce per week, per year, right? That's another, if you have no labor force growth, that's really going to take a hit on aggregate hours, right? It's really going to affect it negatively. So this is a major force, and it's a big reason. I'm doing a big thing right now on how the amazing thing is that earnings, GDP grew like 2% a year last decade, but earnings grew like close to 10%. And nominal GDP, we already grew like 5%, but earnings grew like 10% a year. Well, if you go back to, last 100 years, nominal growth equals GDP. GDP usually equals earnings growth, very close. In the last 20 years, earnings growth in the S&P has been way higher than nominal GDP growth. And the only way they did that was through the labor getting less percentage of sales, right? They're taking away from labor. And now we have this K-shaped economy. You can't keep taking away the revenue, giving more revenue to the owners versus labor and capital, giving more money to capital and owners. you can't keep doing that because K-shaped economies eventually die. They can't grow anymore because if you have very wealthy people that have most of the wealth, they're not going to spend, a high percentage of that wealth. Whereas the 50% or lower income groups spend most of their income. So we know there's all kinds of academic studies showing K-shaped economies will suffer lower growth. So I guess what I'm saying is if we're going to get GDP growth by keep taking money from labor, sacrificing labor for profits, eventually that's going to turn on its head because the economy won't continue to grow. And we, as you know, I'm sure you're well aware, this is the most K-shaped economy ever in the history of the U.S. And it's dramatic between the haves and the have-nots. And that will, if it continues, will actually depress economic growth. So that's another big factor, which is also, Marcus, why you mentioned that everybody buys the dips, right? Well, here's the problem with a K-shaped economy. The wealthy keep spending and keep, as long as the stock market, there's more, I guess, economic growth has been more tied to the wealth effect today because of the K-shaped economy than any time in our history. So if you really do get a down cycle that stays down, so if the stock market somehow went down 20, 25% and stayed there for a long time, or whatever, you get the virtuous cycle, you get the cycle where it would actually affect the economy way more than in past bear markets. So in other words, a bear market is going to affect the economy more than it ever has. So that's another major risk. If we go in a bear market and recession induced, it's going to be really hard to come out of it because it's going to affect spending more than it would in other recessions. So we have that to deal with. But my whole point of bringing up this earnings growth growing faster than GDP is that if you're going to have these high valuations in the stock market, you're expecting higher earnings growth or more stable earnings growth. Well, how are you going to have higher earnings growth if GDP is going to be less than it was, for the last century without sacrificing labor? So we have that, big issue of how we're going to get growth in the future, right? With all those factors I just commented on.
Got So yeah, and that was a lot, and there was some salient points in there for sure. And obviously on the other side, we're looking at a new today while we're recording this. This will come out a little bit later, but this is presumably Fed Chair Powell's last meeting, right? So we have Warsh coming in. I think Tom tells us I'm down here in North Carolina, Wall Street, South Charlotte. Senator Tillis said he will allow the confirmation to go through the nomination up through the board. And so I know Warsh is more concerned with, he thinks AI is going to help the Fed in different ways. He's concerned about AI obviously destroying the economy, but he thinks it's a way that something that we have to embrace and it will possibly help us outgrow this economy. That's just such a diatribe or a divergence in the way that the world's looked at right now, because half of the people and the people in charge of our fiscal policy, by the way, and monetary policy think that we're going to outgrow this that we're at right now with the deficit. That's why they're looking to lower interest rates and reduce the amount of debt that we have so it's easier to service this debt that we're paying. And then they're praising AI for the productivity booms that it's going to bring. But as you just mentioned, AI and this productivity gains, especially when you see in the side of the earnings, the gap in earnings and real GDP, like seems like a formula for chaos. How do you see Chairman, well, I shouldn't call him Chairman Warsh yet, he's not the chairman yet, but how do you see Warsh coming in and affecting this? Because the Fed could actually, this is something they could actually play a big part in, like whether we go into a recession or not.
Well, his number one goal is to reduce the Fed's balance sheet. So if he does that, that would probably cause long-term rates to go up. But he is going to definitely try, in my opinion, try to lower rates. I mean, he knows what Trump expects of him. So every new Fed chairman has been tested in the first 6 months. And what I mean by tested, the markets have taken the stock market or the bond market down within 6 months or a year of when a new Fed. So he's going to get tested likely. So I think the test could be he's going to want to lower rates when he comes in. With inflation still actually rising, especially with oil prices high, the market's not going to like that. And if he is able to convince the rest of the Fed to somehow lower rates, the vigilantes in the bond market could rebel. In other words, the longer term Treasury bond market could sell off significantly because they think he's not going to be an inflation hawk. So that's how I think he might be tested, that he's being too dovish, or it could be that inflation actually goes up a lot and he refuses to hike rates. But so there's a big chance that he is tested within the first 6 months of his term, because for some reason the financial markets, like to test you. It's almost like a rookie in sports when he's on the first sports when he's playing as a rookie, and they test you, whatever sport it is. So I think that's a very, probable, not most likely, if it's going to happen, that would be the most likely scenario where he's trying to lower rates, and the market doesn't like that, doesn't think that's deserved. And hopefully he'll, because the market, the Fed needs to restore their credibility. I mean, they've been calling for this 2% target inflation rate for 5 years. We haven't even been close to it.
Mm-hmm.
So they're losing for me and for the financial markets, credibility for the Fed is one of the most important things for long-term investors in all financial markets. And
globally,
they've lost all credibility by keep pointing to this 2% inflation target. And here's the problem. So, people are more educated in running small and large businesses than they ever have. They know what the Fed target is. So if you're a business owner and he's got this 2% Fed target, and you want to raise your prices by 3%, and you go, no, you know what? I'm only going to raise them 2%, right? Because if that's with the Fed, that's what everybody's going to do. So you keep your prices at 2%, and then inflation comes in at 3% every year. And then the Fed suddenly says, well, we're going to change our inflation target to 3%. Well, what's going to happen if you're a small business owner? You're like, wait a minute, I sacrificed. I only raised 2% because that's what you said the inflation target was. Everybody else was raising their prices more than me because that's how we got to 3% inflation. And now you raise it to 3%. Well, you know what? I'm not gonna honor your expectation of 3% because you didn't honor your expectation of 2%. So I'm just going to raise my prices, 3-4% instead of 2%. So if you follow that pattern, you lose. Not only do you lose credibility, but you lose having an influential effect on inflation, because you've lost the credibility. Then becomes loss of influence. So it is a big deal. So he doesn't seem like he wants to restore that. So I don't, we'll see how it works out. But those are my views on the Fed.
Do you think the Fed stuck the soft landing?
Well, we still don't know. I mean, it's kind of funny because most recessions occur not when the yield curve is inverted, but when the yield curve inverts and then actually becomes positively sloped afterwards. So we're not totally through that yet. We had in 1990 we had a recession after the Fed. We had a big tightening cycle in '88, early '89, and then the Fed actually lowered rates a couple of times, and we still had a recession in 1990. So I mean, it is a possibility. You could still have a recession without the Fed tightening from here, if that, the lag effects, so that's still a possibility. But, right now everything's on hold, which will probably be the case for at least the next couple meetings. So we'll have to see how that goes. But yeah, it's still a possibility. In other words, you don't have to have an inverted yield curve to have a recession. What you do need is to have a inverted yield curve that, a couple years before, and then becomes positively sloped. So we're still in that time period where it could happen.
Gotcha. Yeah, and when David keeps mentioning the invert yield curve, that just means that the shorter term investments, treasury bills, somehow are higher interest rates than the longer term, whereas you should get longer term money for taking a longer risk where people are holding your money longer. But that is usually a reflection upon the government or whoever's issuing that note for them to pay it back. So definitely a salient point in there as well. The soft landing is definitely something we'll have to see. Was inflation transitory? I don't know. We'll see. I think Warsh is walking into plenty of challenges already. I mean, Powell had COVID pretty much right when he jumped in, right? And Trump actually had started some tariffs back then. There were some tariffs going on. Like that's when the tariffs initially started. They just stayed on through Biden's administration. So I think Warsh is definitely walking into some type of situation, to say the
And
least.
also, Martin, I don't know if we discussed this, but spending has exceeded income every month since the fall of 2024.
Hmm.
So you can't do that forever. The savings rate's down to 4%. And even with all these tax refunds, which by the way came in lower than expected, the
Mm-hmm.
tax refunds, um, real disposable income from the time the tariffs were put on until like January was negative. Real wages are really slowing down. So you can't keep doing that. You can't keep spending more than your income. You can draw down your savings to a certain extent, but I don't think investors are aware that we are spending. The consumer has been spending more than the increase in spending has been less than the increase in income for like a year and a half, and that's not good.
Yeah,
That
it's
is not
definitely not good.
no.
And even as you mentioned, to go back a little bit further, when you were talking about the Fed's credibility and the 2% interest rate, and then they set the COLA, cost of living adjustment, off of what's PC. Um,
Yes.
they said that, and that number is still coming in higher. They say our target is 2%. Maybe the Fed should just say, like you said, that the target's 3%. That's where we're fighting with, and let business owners and Americans figure out, well, global community, because our rates kind of set the bar. Like Japan sets the lowest bar, I feel like, but our rates kind of set the international bar as well.
Yeah,
So
but
maybe they should realize that. And then what do you think would happen if Warsh came in, somehow convinced the board to just cut, regardless of it needing to cut?
that's where I said what will happen is the vigilantes in the bond market will sell off the long-term treasury bond. Yields could go to 5% on the 10-year treasury. And that would cause less economic growth. It would cause the stock market to go down. It would cause financial conditions to tighten. So it could have the reverse effect, right? It could actually have the reverse effect of causing financial conditions to actually tighten. So that's the big risk of him doing that. Remember, he can't control, although they can control through buying, through quantitative easing, buying, long-term treasuries, which he's going to do less of, obviously. But without that, the Fed has no control over long-term rates. So, it could backfire if he tries to do too much. But if he tries to lower rates and the market doesn't want that. So, they're in a real predicament, a real catch-22. We basically have stagflation right now.
Yeah,
Yeah,
self-inflicted.
year over year GDP growth was only 2% last year. So a lot of people
Didn't
say
they
the
revise
tariffs.
that down?
I'm sorry.
Didn't they revise that down too?
Yeah, that was
GDP?
down to 2% year over year on a fourth quarter to fourth quarter basis, which is a big drop from before. So people comment that the tariffs didn't really affect the economy. Well, first of all, it slowed the economy down because
Hmm.
everything. If you look at uh, real GDP growth slowed down a lot. And then you had inflation higher. Everybody, inflation came down, but actually tariffs probably caused about 50 base, about, I don't know, maybe, a half percentage point increase in the CPI when it would have otherwise would have been. Um, so, you do have that. Uh, we're still contending with, which is still kind of rolling off, but
To say tariffs didn't cause any, like they weren't impacting the American people, is very interesting, especially when you look at the fact that now we're giving back tariff refunds. So clearly some money was somewhere inside of tariffs, right?
well, yeah, but they're going to go back on with all the different options he has. Well, the interesting thing, Mark, is whether who's going to get that money, or consumers going to get it, or the businesses are going to get it, or is it going to
You,
be, there's lawsuits all over the place now.
you took the words right out of my mouth.
Yeah, the corporations are getting it right now because they're the first ones. But how do we know? Does the consumer benefit because the consumer had to pay higher prices, which is pretty well documented. Just
There's no,
because So what, Marcus, people didn't understand. So the inflation rate really didn't change much, right, after Trump took over with the tariffs. However, that doesn't mean tariffs didn't affect the inflation rate, right? So in other words, if the inflation rate stayed close to 3%, and so people say, well, the inflation rate didn't go up with tariffs. Well, it that's not the way you should look at it, because inflation would have been lower if not for tariffs. So even though it didn't go up, it would have been like 2.5% instead of 3%, right? So that's what people don't understand, that it still did cause higher, and most of the offset to tariffs was lower oil prices last year. That was a big factor in pulling the CPI down, a major, probably the biggest factor. Well, we're not going to have that this year, right, to offset. So yeah, so it still had, the tariffs still had, people don't understand and know economics. Tariffs actually cause more economic slowdown than they do higher prices. So we're seeing that. We saw the Atlanta GDP tracker for the first quarter is what, 1.2%. So we just did 2.2% year over year, fourth quarter to fourth quarter. Now we're going to do 1.2%. So that's 5 quarters of subpar growth since the tariffs. So yeah, I don't know how people can say it didn't affect the economy and it didn't affect the inflation rate. Um, some of these tariffs just don't make sense. Vietnam. In Vietnam, shoes and things like that they make in Vietnam are literally 50% cheaper to produce in Vietnam than here. So if Trump puts a tariff of 20%, which is what it is now in Vietnam, how does that help anything? Because it's not going to move manufacturing of shoes and apparel, whatever, to the US, because he'd have to have 100% tariff in order to make it worthwhile to move to the US. So when you do a 20% tariff on Vietnam, all you're doing is put a tax on American consumers, because there's no benefit of trying to reshoring at 20%. Do you follow that? That
Yeah.
it would have to be like over 100% tariff in order to get reshoring from Vietnam. So what's the point of having a 20% tariff? I mean, all it does is it's a regressive tax because shoes and are a higher percentage of income of lower income people. It's just a regressive tax in the U.S. It's makes no sense at all, and increases the inflation rate.
Yeah. Yeah, tariffs are definitely something that history's showing. And the Fed, even going back to the Fed, they just keep they don't speak about the tariff impact, I think, enough. Like, they just kind of say they keep waiting to feel it hit or see it hit. But the Americans and people, we know when we go out and shop that things have gotten more expensive since last year. And you can pull out a fancy chart and show us parts here and there and why. But like you said, oil was a big part of the deflationary pressures last year. Oil's going to be higher. The beef prices, going back to the tariff. So we had to change some of our import rules with beef, so we could get lower prices there. When it's like we should already be sufficient here. It's just a mixed bag in this economic detox that they said we were going through at the beginning of
Well,
last year.
also really important, and nobody knows, is non-defense R&D spending under Trump is gone down 25%.
Hmm.
That has been the government R&D spending has been about 20 to 30% of productivity growth. It accounts for 20-30% of productivity growth in the last 100 years. So that is a big deal that now that's a little more longer term kind of effect, but you more than pay for federal government research, non-defense. You more than pay. Every dollar produces like $3, of income. And we have cut that by 20-25%. And so that's a major long-term negative effect on the economy as well, that people are not really aware of. So there's other factors. But one thing I left out, Marcus, is the high yield market. The high yield market, even with the private equity getting hit, has actually stayed pretty stable. But I use the Bank of America option adjusted yield spread. That came down to basically match record levels in January of 25. And what that is a sign of complacency, extreme complacency. It was only that low in 1997 and in the fall of 97 and in 2007. And within a couple of years of that, months or 2 years, we had a major, major recession and bear market. So it's a contrarian signal when the high yield spreads are that low, low, almost 2%, low, 2.5% spread. It is actually a contrary to negative signal that people are being way too complacent about credit.
Mm.
And we've had now 15 months since that hit in January of 25. So it's another variable that's worked well in the past. And so you have to be very aware when complacency on credit gets that high. And we're already seeing some things in the private equity market this year.
So that's yet another sign of the bubble, as
Yeah,
you were
another sign
mentioning.
of a bull market coming to an end. Yes.
So pretty much I can just set my timer for 2027 to like
Well, I don't know that,
2034.
the timing of this is going to be tough. I mean, it's it's going to be hard to know exact. It could be as late as the fall of 27. I don't think it's going to be past that. I'd be
Okay,
shocked. I'll be shocked.
David. So yeah, you're great, man. Sitting over here just giving all this great information. So we need to let Main Street know, because you saw these things coming, you predicted them, you've done this, you've called highs and lows for those who don't know. If you were investing right now, not particularly positions, how would you position yourself for what you see coming?
Well, the next 10 years, if you just invest in an S&P 500 fund, index fund, you're probably going to make very little money, if any, and especially on a real basis on adjusting for inflation. So you're going to need to be more conservative. You may miss out on the next 6 to 12 months of this internet bubble, but if you're a long-term investor, it's worth it at this point. So you want to, if you're going to invest, you need to invest more in income-oriented stocks, and especially for the next couple of years, more of the income-generating stocks that are not cyclical. So that would be one area. I maintain a decent amount of cash, and you got to be tactical. Tactical, I mean, when you do see the downturns, you start to buy. And because believe me, I've been in this 40 years. You're always going to get opportunities. It just happens. It's human nature. People get overenthusiastic, overgreedy. So I would try to stick with, really good, high quality. You want to go to high quality at this point in the cycle. We're late stage of the cycle, and stick with good low valuation companies, stocks, and don't be tempted to try to jump into to the bubble stocks, the bubble this late in the stage, even though you may miss out in the next 6 to 12 months, because it's really difficult to time. Your question more is about if you're 10 to 15 year investment horizon.
Any
So
horizon.
yeah,
You can break it
that
down
would
for the
be better.
listeners.
So so it's very important to be more conservative at this point in the risk cycle. So yeah, that's what, bonds will be fine. I am not, I mean, I think bonds are going to have more difficulties because of the government deficit. So I wouldn't go too long in bonds right now. Although if you see a recession coming, I would up my allocation to bonds. I'd completely stay away from private equity right now. Wouldn't even go near it. Or I would stay away from the high yield market right now. Just way too much complacency. You'll get an opportunity within the next couple of years, believe me, when spreads widen. So so a much more conservative type of portfolio at this stage.
Yeah.
People are just completely, especially healthcare stocks. Healthcare stocks are really attractive again. They had this big run from July until December of last year, and then they gave a lot of it back the last few months. But you have companies like Medtronic, a blue chip medical device company that's been high return on capital, incredible franchise, and they're growing, close to 10% a year earnings, and it's trading like at 16 or 17 times earnings. I mean, this should get a premium because it's recession proof. They don't have a lot of drug exposure where, we're trying to medical devices, the prices actually are flattened down for most medical device companies. So they're not in the crosshairs of the Trump administration. And they, you got the demographics with, the baby boomers retiring. So, and it yields like over 3%, a dividend yield. So those kind of things nobody cares about when you're in a go-go market, but they will care. So that's where I would be emphasizing.
Got you. Okay. And so we can't sit here and stay in those positions for ever or forever long. What signs should people be looking for? Say they make the move, because that seems to be the problem when people try to time the market. Because you're talking about
Well,
becoming clearly less, not getting out of the market, but taking less risk. So being more
yeah,
risk off.
yeah.
How do you know when to put the risk back on?
But investing in more conservative equities for one, and staying away from all the risk private equity, high yield. Stay away from those for now. It will come. You'll get a chance, but now's not the time.
Can you expand on private credit and private equity while you stay away from that?
There was so much money put into private equity and private credit over the last 10, 15 years. And it just, when you have that much money, you're competing for capital, which means you're going to offer better and better companies that are running the private equity. They're offering better deals, meaning more risky, in order to get the deals. So if your private equity was doing, they were investing in companies and get 10, 11, 12% a year in private credit. You don't get 10, 11, 12% a year without taking risk. Okay. Because if the companies were that good, they wouldn't need to go to private equity and get loans at 10, 11, 12%. So that's telling you something right there. And there's just too much money. Anytime too much money, chases too little capital, you end up making deals that you shouldn't make, which is what's probably happened, especially in the 2021 timeframe, where some of this stuff is coming due. They were making really very liberal terms, a lot of the private credit and even private equity. So, and private equity is tied to the stock market, and so they need exits. And if the market's this high priced and is vulnerable, they're not going to be able to exit as fast as they would like. And then the things they're investing in a high price right now. So, yeah, I'm not a fan of those two areas right now at all.
Got you. And you also mentioned the move in healthcare. You said how healthcare had a run from like October until now. Something else that had a parabolic run that has come back down is gold. What are your thoughts with gold and metals? And I think we saw the basement trade, but maybe we didn't.
Well, you don't want to know my view on gold. I don't invest in gold. It doesn't produce anything.
No
But
intrinsic value.
the biggest thing for gold is it's not correlated with anything. So people think it's correlated with inflation, right? Inflation in 22, the biggest spike in inflation ever, maybe except for the late 70s, and gold hardly did anything. Inflation peaked the core inflation rate peaked in October of 2022. And gold actually then started going up, bottomed. The exact opposite of what you would expect, right? And so then it had this amazing 3 or 4 year run, gold, when inflation was coming down, the steepest it's ever come down, except for the early 80s. So if inflation was really correlated with gold, this past 5 years really did not work at all. But I have a really funny story about gold. So
Perfect.
I was at Morgan Stanley in 2002, and we had two really smart guys, and they gave presentations. And this is when gold was at the lowest. It was like $300 back then. It had been in a 20-year bear market, gold, since 1980 and 82, whatever. So one guy gets up and says, because we were trying to get out of recession in 2001 too, and so the Fed had really lowered rates dramatically, and he said it's going to cause hyperinflation. He says, I'm buying gold because we're going to have hyperinflation, and so gold's going to do really well. The next guy gets up and he says, gold, I'm buying gold because there's going to be deflation. We're trying to get out of this deflationary period, and the Fed's lowering rates, but they're not going to be able to. You can't push on a string, was the saying back then. So gold does very well in deflationary periods as well as in inflationary periods. So I'm really, so I thought about it for a while, and these are two bright guys, and I thought, I think inflation is just going to be like it was in the 90s, 2.5%, 3% a year. So I'm not gonna, I don't, I'm not, I'm not gonna believe what they say. I mean, what they're recommending. So what happened? I was right. Inflation went up like 2.5% a year. The other two guys were totally wrong. The one that said there was going to be hyperinflation, the one that said there was going to be deflation. Yet they made a fortune. Gold went up like tripled or quadrupled during that period. Where else can you be? So two guys were totally wrong and made a fortune. I was totally right and didn't make a penny. So that tells you about gold. There's no. I have researched it. People say really, really low real yields. Well, we had the lowest real yields ever last decade. Gold did nothing, right? They say inflation. They say geopolitical events. Maybe for the very short term on geopolitical events, but there's no correlation in intermediate to long term. What's the other oil prices? Oil prices correlate with gold. Guess what? Gold tripled in the last 2.5 years, while oil prices went straight down. This is before February this year. Gold had tripled, while oil prices went straight down for 2.5 years, completely negatively correlated when everybody says they're positively correlated. So, and I also think, I know this is crazy, I also think that gold is going to be replaced by man-made gold someday. There's now
like diamonds?
there's a company called Marathon Fusion that's a private company that's raised like 10, 20 million. And one of their goals is to produce through nuclear fission to produce man-made gold. I don't know if you know this, but man-made diamonds, which are really hard to detect if they're not real, have caused the price of diamonds in real terms to go down 40% since 2012.
Huh.
And so with all this new AI and stuff, we're gonna be making man-made commodities, not having to dig underground at some point. Obviously, it's still a theoretical and still way off, but it will probably happen faster than you can think. So that's another risk. But yeah, gold, I have done a lot of research on it, and there is almost no correlation with anything except for price momentum. If you buy it when it's up a lot, it's up, if you see it on a 20% move and you buy and you put a tight stop on it. And because when gold tripled in the last couple of years, there were only 2 or 3 10% corrections. That's it. So you never got scared out of your position, right? So it's just the best way to play gold is on a momentum basis. If it's going up strongly, you buy it with a tight stop. And so because there's no other correlation with anything. And by the way, fair value in the long term, fair value of gold is usually about 50% above the production cost. Production costs right now about $1,700, $1,750. So the fair value of gold is probably like $2,500, $2,600. So it'll eventually get to 50% premium to the cost of gold. It may not happen for 5 years, 10 years, but if you're a long-term investor, I don't think it's a good entry point.
Got you. Are there any commodities that you like? I mean, you didn't like oil, you don't like gold, or any commodities?
I thought copper was pretty good because, it's tied. There's a lot of copper and, electrification and all that. So, and there's been some disruptions in copper production around the world, even before the Iranian war. So, yeah, I mean, I think we're short-term commodities look okay, but I'm never a big believer in commodities. Commodities over the long term, become less part of our economy. I think between 1800 and 2000, there were only 3 commodities that outpaced inflation. They were timber, fish, and I can't think of the third. But people say oil did not outpace inflation from 1800 to 2000. Well, gold did. Gold did because when we off the cycle, the Bretton Woods. But so commodities over time, especially with AI now, and with all we have, is going to be less and less important, in my opinion.
And so, and for people listening, they should realize that, yeah, David knows what he's talking about. He's made some great market calls. Let's take a second, and I want to respect your time. We've been on here just talking. This has been a great conversation. Take a second and just go back through some of the history, maybe if you can, to let people know like some of the things you've called, some of the things you've seen, and maybe how you saw them and how you called them. Even though you may not have said them yourself, you might have wrote it out there, you put it out there. How are you getting these market calls out?
So, yeah, I have an investment strategy letter, Journey One Advisors, and I've been doing it since 1986. So, my biggest call was in the financial crisis in November of '07. I made a big call that there was going to be a massive bear market recession, and I actually have that real time research report on my website that was written in real time. And then in April of '09, I put out a massive 35-page paper on how this was the start of a new multi-year bull market. So I didn't get the exact bottom, but I did get close. I mean, close in the sense that I got the direction right. So yeah, I did have that. My biggest mistake in investing was in 2000. Even though I knew the market was way overvalued in 98, 99, I stayed with it. And in March of 2000, I called the exact top in tech stocks. And um, they dropped dramatically in the fall of 2000.
Like
And I went,
70, 80%, right?
yeah,
The
well,
NASDAQ?
not at that point. At that point, they dropped like in half.
Okay.
And I went back in and with hands that full, and I got back in way too early. I mean, I knew it was a bubble, and I just didn't realize when a bubble bursts that it takes more than 6 months to revert to the mean. And so I remember like Oracle when it was down like 50-60% from March to October, and I jumped in and it went down another 60% after that. So that was my biggest mistake was getting in to I called the top, but I got in way too early. And I also got the Fed had lowered rates in January of 2001. And every time in the past century, when the Fed started lowering rates, the market went up. It was the first time the market didn't go up, Marcus, in 50 years when they aggressively started to lower rates. So, that's a whole nother point. There used to be Marty Zweig was one of my gurus, and his saying was don't fight the Fed, especially when
Mm,
they're lowering rates. That
mm,
completely changed in January of 2001. January 2001, we were down 20% in 2000. The bubble had burst in the internet, and the Fed lowered rates 2 or 3 times in January. The market went up just like it normally does when he starts lowering rates, and then it died. And then the Fed lowered rates like, I don't know, 5, 6, 7 more times over the next 2 years, and the market kept going down. That never happened before in the history of our stock market the last 100 years. So this whole thing is no longer valid that don't fight the Fed. We had
mm.
in 2007, they started lowering rates in in October of '07. And for the next 18 months, they lowered rates to 0 from where it was like 5.5. One of the big, massive loosening cycles ever. And guess what? The market went down another 40, 50%. So now you have you can't just say, follow the Fed and everything. Tightening still has a negative effect. But on the loosening side, you have to get to a threshold now. You have to know when is it the third interest rate drop? Is it the seventh drop that's really going to spur the economy and the stock market? You did not it was so much easier to invest from 1950 to 2000 because every single time the Fed stopped tightening and then started to lower rates, the market and the economy responded. And part of it is that what we call velocity of money peaked in 1999. So even if you increase the money supply, it's the velocity, the economic is the increased supply times the velocity, and that has changed since 1999. It's been much lower velocity of money. So lower rates don't necessarily get multiplied through the economy. The velocity is just how much it's multiplied through so these people, it's a much harder environment now to invest in because you don't have that ease, that security that if the Fed's lowering rates, everything's going to be fine. We just saw in 2000 and in 2008, 2 times where it completely did the reverse. Lowering rates just led to lower and lower stock market, and the economy got worse and worse. Not that it caused the economy getting worse, but it didn't help. So that's a real big distinction versus the prior century. Not many people talk about it.
Yeah, it's definitely the Fed and the rates and the returns and the rate of the
Yeah,
return have definitely all changed. We
yeah.
saw
It's not as good a signal as it was in the past.
right. We also saw like with the Fed cut nearly 100 points. When was that? 25? No, 24, end of 24,
Yeah,
and the
yeah,
interest
yeah,
rates went up.
yeah.
Like the 10-year went up, mortgage rates
Yep.
went up. That goes back to the focus. Yeah, man. This has been a really good conversation. You all right? You need a drink of water?
I'm fine. That's fine.
Perfect, perfect. Let me while I have you here, I'm borrowing Dave. David is he's a wealth of knowledge. People, how did you get so smart about all this stuff, David? Like, tell us a little bit more. I'm trying to get back into like
Okay. So
back into the how did you get to this point?
so I got in the business in '86. So I've seen everything.
86.
I've seen
Okay.
40 years. I've seen the world end and come back. I got in a year before the stock market crash of '87, so that was a real
Woo.
awakening. So yeah, I was always interested I was an economics major in college, and I was always interested in the stock market. I practiced law for a couple years, and then I got into the business, and I've done a lot. I've just really enjoy doing research and writing investment strategy reports. So I've written them for 40 years. So I have I'm really, I'm more historical based. I like to look at historical patterns to see because they repeat so much. So I have a real good sense of history going back to the 1800s about the financial markets. And so I use a lot of it, apply a lot of these historical patterns to today's markets. And things do change and you do adjust for that. But most of the time, you know, it's not different. That old saying, it's different this time. Um, so yeah, so I was very research intensive, do a lot of reading, just multitude of research reports and economic reports. It takes a lot of work and, just have a real sense of history um, and really, I would say that the biggest thing is just trying to not be influenced by other people. If I do my research, I try to pretend like I'm coming down from Mars and say, wow, this looks like this, or this looks like that. And then I'll, see what it is in reality. And then I'm like, wow, that's so much different than what the status quo is today. I try not to be influenced by the status quo and not accept a lot of things that other people accept. So I tend to be skeptical of anything. In other words, I want to look and make sure that whatever people are saying is actually factually correct and also has intuitively is correct as far as their conclusion. So that's a big part is just doubting everything, and working from there and trying to prove that that's my theory is correct or whatever, my thesis.
Yeah, you're a data dog. Something hits
Yeah,
the floor, you're
yeah,
sniffing it, getting ready to go.
yeah. So, I've done a lot of, I do a lot of research, as I said, and a lot of long research investment strat. One of my reports are very detailed, so they can be cumbersome at times. So I try to, make sure I get the point across.
How many words are these research papers usually? Like general range, or
Uh,
I guess pages for people who don't
they
look at
can
the
be
words.
they can be 10, 20,000 words. Yeah,
Really?
yeah,
So
yeah,
you do go deep into your
yeah,
research.
yeah. So I just did in December. I did this massive research report because I wanted everybody to hear my views on almost everything in the financial markets. That's still on my website, and it's broken down into about 20 different categories. So if you want, you can just pick your own category if you want to review it. But I just want to make sure I got everything out that to be on the record of what I thought at the time.
How is it holding up, your research,
Uh,
4 or 5 months in?
you mean how there's everything I've said? A lot of it's a lot of
Well, Yeah, just from like the December letter.
A lot of it's, I mean, a lot of it's coming true so far. I mean, so, it's more longer term. We'll see in the next couple of years. It's really more of a longer term strategy piece. So I don't, we'll have to wait and see. Um, so yeah,
Perfect. All right. Good, good, good. David, this has been a long, great
yeah, it's
conversation.
long.
It's
Yeah,
been a
yeah, I
long, great
really
conversation.
appreciate it. I
I
appreciate it.
guess before we hop off, I found you because obviously people don't realize if they listen to you speak, they've heard a lot of what's being said here, like your mannerisms are being put out in the media, but you're not popping out there. So so your research papers are how people found you. How did you get connected with those people who do that? They just read your work and then just
So what
they
happened
reached out
is
to
that
you?
I would send my research reports to Michael Santoli at CNBC
Okay.
starting in like 2008, and he really liked the reports, and he started publishing my research on. He was working for Barron's then, and then he moved to uh, CNBC like in 2015, I think, and he continued to rate and rate and also cite a lot of my reports all the way through. So I became known on Barron's and CNBC for my investment strategy pieces. And then, of course, I had my first appearance on CNBC. I got on December 30th of this past year. So he had always referred to me as the mystery broker. So it was kind of it was pretty cool. It was the unveiling of the mystery broker. Nobody knew my real name until that unveiling on CNBC. So that was pretty exciting and fun to do the unveiling. But yeah, he, as I said, he had written, I'd cited my reports all the way through. So it became I had a decent pretty big following.
Nice. So your good hard work came out. You just put it to the right people's hands, and they realized that was good
Right.
stuff. Yeah, I got David in here like, whoo, he needs a drink of water. We're gonna hop up off here in a second, David. I guess let the Main Street audience know where they can find you if they need anything, where they can get that research from, and then anything else you want to tell them before we hop off.
So if you need, yeah, my website, my firm is Journey One Advisors, and my website is Journey, the number one, not the number, Journey, the number one advisors.com is my website where you can find any information you want. There's some research reports. If you want to contact me, you can do it through the website, and we can go from there if you're interested.
Perfect. There you go.
I don't know.
Tell them
I'll
tell
try. I'll try. I'll try. You got Adam Parker, so
yeah, Adam Part.
Yeah.
The podcast has been doing great, man. We've had a lot of really cool guests on here. I don't
Yeah.
know if people realize, and we've done
Yeah.
the reports on, uh, like live reports from the war since it started happening. It's
Oh,
been
okay.
really
Cool.
cool stuff for anyone who's popped on. But yeah, David, you have to come back on here
Okay.
and also let me know when me and you can do a live session so we can hop on.
Okay.
But unless there's anything else you want to tell Main Street,
That's all. Let's wrap it up.
all right, Main Street Heart meets Wall Street Smarts. David Snyder, the mystery broker. Thank you so much.
Thank you.